Welcome to Scottish University Module 1, Psychology, Lesson 4, Think Like a Whale. This lesson is going to be filling in the rest of the picture in terms of the psychological aspect of the markets from the perspective of essentially your rival, which is the whales, market makers, smart money, whatever you want to call them. The people who control the market, the people who move the market, the people who create the market that you trade in. If you want to be able to win in this game, you need to be able to think like a whale because your goal is not to beat the whale. So you can either think like a pleb and battle a whale, or you can think like a whale and battle a pleb. Okay? Because the whales, by and large, take money from the plebs, the fish, as we call it, which is it's well known. The whales buy up all the cheap coins, run the price up, and then they sell it to retail who FOMO in at the top. So if you don't break out of that conditioning of thinking like a fish, then you will be forever battling against the whales. But if you understand how they work, you can piggyback on the whales' moves and take money from other fish. So you don't need to have an endless bank balance of 8 figures, 9 figures, 10 figures to trade like a whale. Because essentially what trading like a whale is just trading without fear. Whales have no fear of trading because to them it's just a game. There's no financial burden on them, even though they're throwing around millions and millions and billions of dollars, more than you could ever dream of trading. To them it's not life or death. And it's not life or death for you either as a retail trader, but it's made out to be that way because you're trading with 20 grand and you lose 500 bucks, 1,000 bucks. It feels like the end of the world. A whale trading with 1 billion can lose the same percentage. If you're trading with 10 grand and you lose 1 grand, it's catastrophic. If they're trading with 1 billion and they lose 100 million, that's a bad day at the office, but it's not going to kill them. They still eat, they still live, still have private jets. There's nothing's going to change them functionally. And so with that, they can trade without fear. They can view the board from a higher level. They can view multiple steps ahead. They can play the long game. They can do all the things that you, as a retail trader, have access to, but typically don't enact through impatience, desire to get rich, a sense of entitlement that the market owes you money, many, many, many different things. And we'll go into all that now about how all of those assumptions that the average trader has about the market are all crafted carefully by the whales to keep you poor. All right, so going through lesson 4, Think Like a Whale, we start with the concept of liquidity. So rule 18, buyers want to buy, sellers don't want to sell. So this is especially true in cryptocurrency and in the markets of Bitcoin, Ethereum, and alts. This is especially true in crypto because it's such a one-sided market. We do have, a 95% long-only bias. And so what that means is everybody in crypto wants to buy, so we're talking about the average trader here, because for every whale, you've got 100,000 fish. So if the average trader Their only way of getting rich is to go long, is to buy a coin. And you're taught to buy the coin early, buy it cheap, goes up, and basically pray for 100x. Right? You can't get 100x on a short without insane leverage. The maximum you can get on a short is minus 100, which isn't even feasible. In reality, it's more like minus 80, minus 90. But with no leverage, just buying a spot coin, it can easily go 1,000%, 10,000%. So that's the key difference in crypto versus the regular markets. If you trade stocks and commodities, especially stocks, maybe you when you buy a stock, you maybe like the company, or you've researched it and you fundamentally believe the company's good and it should go up. So yeah, maybe in stocks it's a little bit similar, but certainly if you've ever traded commodities, you'll know that you don't care if price goes up or down. You're a directional trader. If you believe silver is going to go down, you're going to short it. You're not going to be a silver maxi. Now, you do have gold bugs. That's a whole different story. But if you're trading grains, if you're trading corn or soy or wheat, you're not going to care whether it goes up or down. You're just going to base your bet on whether you feel like supply or demand is going to be dominant. So crypto traders are extremely weak and extremely easy to prey on, because they essentially come into the game giving their hand away. So if this was a game of poker, the crypto fish, the retail players, are coming in with their hands face up, and the whale can see exactly what they're doing, because they're coming in and they are looking for opportunities to buy. They're not looking for opportunities to sell. Really get that into your head. That's super important, because put yourself in your own shoes, because we all do this. You do this. Even I do this. If I'm looking for a good trade, I'm generally looking to buy something and hold it. What you're looking for is, you're marking your chart out, you're tracking prices, you're looking at your indicators, you're setting alerts, all with the hopes of finding a good opportunity to buy a coin. Okay? Let's imagine this is no leverage, just spot. You want to buy an undervalued coin. So if you're a whale, how do you view that? Well, in every trade, there has to be a counterparty. Yeah, there has to be a buyer and a seller. So 95%, probably more, but let's say 95% of the market is long biased, because they're just retail who just want to buy a coin on Uniswap or on FTX or on Binance. They just want to buy that coin, it goes up, they get rich. So that's 95% of people's opinions. That's 95% of people's mindset coming into the market. So that 5%, who are generally whales, market makers, or other delta neutral traders, they have to provide the liquidity on the other side. Okay, for you to buy your moon bag, someone has to sell it to you at that price. Now you are buying something. Just think about this, and this might even, this might shatter your dreams about crypto a little bit. But by and large, if you buy a coin expecting 100x, that means you believe that the person who sold it to you is just about to make the worst trade of their life. They're about to sell you something that then goes 100x. Why would anyone do that? Why would anybody sell you a coin if there was even a hint, even a fraction of a hint that it might go 100x? They wouldn't. So you have an way outsized opinion of what the market actually is and what the market owes you, which is nothing. The market owes none of us anything. But people think, because it does happen in crypto, but people just think, even a 10x, like, you buy a coin, especially if it's on an exchange like FTX or Binance, so it's a mainstream, let's call it, coin, and it's highly traded and it's liquid. That means it's going to have market makers, because if it's on a centralized exchange, you can see a bid and an offer. You can see the order books. That means there's buyers and sellers. If there's buyers and sellers, that means somebody's making a market. And that means that even if you buy a coin, when it's down on a dip or whatever, and you expect a 10x from, let's say, what's like a middle of the road coin, let's say Aave, which is probably like in the top 100 somewhere, and you think, oh, it's going to go 10x. You're just like, someone has had to sell that to you at the knowledge that they think not only does it not go 10x, but they think it goes down, because they're only selling it to you because they want to buy it back cheaper. Understand? So you have to figure out and just internalize that liquidity creates its own counterparty, all right? And that buyers want to buy, but sellers don't want to sell. And so what that means is price will travel through the books and through the market, through the area of least resistance, until it reaches an area where it is met with willing buyers and unwilling sellers. So the image on the screen encapsulates this quite well. You can see the price, as we go down here, price basically tumbles down through the books the whole way on very little resistance to it, so there's no support, but there's very little resistance to it stopping. So nothing's stopping it from dropping until it gets to where we have willing buyers in the form of, this is a heat map, so these are orders, and the lighter yellow color means more orders. So these are orders stacked on the books. This is what you would call a buy wall. Okay, you have buy walls and sell walls. And so what turns the market? Well, the market turns when it meets passive liquidity. And it's actually volume indicates a trend change. Okay? And the conventional wisdom for like boomers in the traditional markets, if you've read any trading textbooks, they'll tell you that volume should rise on the way up to signal a bullish trend, and it should rise on the way down to signal a bearish trend. And that rising volume indicates trend continuation. You've all heard that, conventional wisdom. Well, the thing about conventional wisdom is it's almost always wrong, and in this case, especially in crypto, it's 100% wrong. You're taught to trust a trend if volume is increasing, and to be wary if price moves on low volume. So you might hear, typically, about a coin going up with low volume, and people say, oh, this is thin, not a great move, no strength in this move, there's no impulse, price is just rising on no bid, But the crypto mechanics are different. So for a few reasons, in the traditional markets, you have liquidity is by and large real, okay? So the orders on the book are legit. The volume that's traded is legit. In crypto, it's unregulated. There's a lot less clarity, and there's a lot more spoofing, fake bids and fake offers, and fake volume even, using volumizers, which is essentially just wash trading, where an exchange will buy and sell coins very quickly in it, just buy and sell off themselves using high frequency bots to increase the volume being traded, so that for a number of reasons, one of them being that traders think that the market's more liquid than it is, so they'll trade there, so that the exchange's stats are higher, so they, being the top volume exchange gets them a lot of publicity and attracts more customers, many, many different things. Now that's all completely illegal in the regulated markets, but crypto's unregulated. But because of this, the mechanics are totally different in crypto and between crypto and TradFi. So you have a lot more spoofing which means that low volume moves are actually indicative of continuation. Okay, you understand? So if the orders, and if you've ever watched order books, you'll understand what I mean, that if you're watching live order books, you'll see that what moves price isn't, in general, in the middle part of a move, so not at the bottom, not at the top, the bit in the middle. It's generally not high volume that moves it in crypto. It's actually the offers being lifted and the bids being raised, so bidding it up. So instead of aggressive buying and selling, it's actually just that people are moving their offers up, so they're moving their sell orders higher, which then allows price to move higher because there's less resistance. Make sense? And in keeping with this directional trade, so let's say the market's going up, then as the people are lifting the offers, as they're moving their sell orders up, they're also moving their buy orders up beneath to try and catch any dip, because you see people that want to chase the momentum, so they chase it up with limit orders, called limit chasing, and that moves price up. And price continues to move up because there's a lot of buyers below and the sellers above keep moving it higher. But what all that means is it'll move up on lower volume, because it's not so much the people that are coming in and trading it, it's the fact that the market is moving the resistance higher and higher and higher. So by offers getting lifted or bids getting pulled, which is basically market makers getting out of the way, we can see that low volume moves are often indicative of continuation. So what does that mean? Well, that means that conversely to the traditional markets, when volume rises in crypto, that is when the whale games have started. All right? When volume rises, you can assume it means that passive players are stepping in to participate. All right, and who creates tops and bottoms? It's passive players participating. It's whales, big players, and smart retail traders, but by and large, it's big players because they're the ones with the heavy hands. And exactly what you see on the screen, that's a key low, 40K on Bitcoin, high time frame support on daily, weekly, and monthly. Price traveled down to that area with fairly low resistance, and then suddenly met with a wall of support, because at 40K, the big players already had it marked down and said, yeah, 40K is where I step in and buy. And because price has been moving down for so long, it's exhausting its momentum, because it can't go down forever. People aren't going to continue selling forever. And then suddenly they see this big wall of buyers and they're still selling into it, and price stops going down so much, and then it reacts, and eventually it gets absorbed and moves in the other direction. So demand creates supply, all right? Not the other way around. Because when you're traveling, price is traveling through the books, the big players won't step in until there is liquidity. There is sufficient liquidity to trade. All right? So at tops, that's created by willing buyers. And at bottoms, it's created by unwilling sellers. Understand? So when I say demand creates supply, that's because when Bitcoin gets to 64K and it looks like it's going to break to a new all-time high, even though this is at high time frame resistance, people are tripping over themselves to buy it because they think they're buying the all-time high breakout and they're going to buy it here and it's going to go to 100K. And so what they do is they start adding liquidity. They start buying it at an insane price. These are people who aren't buying it now at 42, but they're willing to buy it at 64 because the demand is there. Liquidity creates its own counterparty. So as all those people, it's actually a self-fulfilling prophecy in a negative sense, where these people who believe that buying it below all-time high just before the breakout is going to create, it's going to get them in early for this breakout trade, which goes to 100K. As soon as they start willingly buying, the whale's just going to step in and say, oh, what's this? This is my exit liquidity.